Hi, Sheila. Hi, Eric. We're going to give everyone a few minutes to arrive, and then we'll get started, okay? Okay, guys, I want to thank you all for joining me today. Unfortunately, this is the way we're going to have to lecture Chapter 3. It's not my most fun way of doing it, but I don't want us to fall behind schedule. The good news is that if you need to come back to this recording as you're working on your assignments, this recording will be here for you to listen to. I'm not sure how long it's going to take us, probably a significant portion of the time. It depends on, if you have questions and things like that. So I'm going to get right into the material, and I'm going to share my screen, and I'm going to do some notes in Word. So right now you should see my Word program up with a blank sheet. And if you have any questions during this, please stop me, unmute yourself, and just ask a question. Not a problem. Okay, so I do have your test corrected from the other day, and your grades are entered into Canvas, and I'll bring those with me on Thursday so we can review them in class. But today we want to focus on the lecture for Chapter 3, which is a continuation of Chapters 1 and 2. So right now, we could give this whole process we've been working on since day 1 of class a name, and it's called the accounting cycle. The accounting cycle lasts 1 year. So sometimes you'll refer to it, or people will refer to it as the accounting year. And what that means is there's various procedures or steps that need to be completed during an accounting year. And you've already done the first 3 steps in Chapter 2. So the accounting year always begins with, and for the majority of the year, creating journal entries for each business transaction. Okay, so for the majority of the year, that's what you're doing. Creating journal entries, posting each journal entry to the affected T account in the general ledger. Okay? And we keep doing that and doing that and doing that, okay? Until sometime we have to make a financial statement. Now we have to make a financial statement at least once a year. But sometimes we may make them every month because our boss asks us to, or maybe twice a year. Okay, so you don't have to only make it once a year. You can make it 12 times a year. Heck, you can make one every day if you want. That's not normal. Companies I've worked at, we've made a set of financial statements each month. So that's what spawns or sets off the next part of this cycle. And that is finding a balance in each account and creating that trial balance we learned in Chapter 2. And we give this trial balance a name now. It's called an unadjusted trial balance. Remember, all a trial balance is a listing of all the accounts with their balances. Okay, so that's what says do an unadjusted trial balance. You're getting ready to do a financial statement. Now, on our test the other day, we did use an unadjusted trial balance to create financial statements. But this isn't the trial balance we actually do use. And that's where chapter 3 comes in. We have another step in the process. And I'm going to write the steps down here. And then I'm going to tell you why we do them. Where did this come from? We do special journal entries next whenever we're going to do a financial statement. And they're called adjusting journal entries. And they're journal entries done for a special reason. And essentially, here's what it is. At this time, we try to identify any revenues or expenses that are not recorded yet for the year. Okay? When we do an unadjusted trial balance, we can't sit there and say everything's recorded for the whole year because we didn't prove that. Here's how we prove it. There's 2 principles that we must adhere to. The first is called the revenue principle, and that tells us when you should record service revenue or revenue of any kind. And here's the key, and we've already talked about this. Revenue is recorded when it is earned, not when you get the cash, when it's earned. So during this next part of our accounting cycle, when we're getting ready to do a financial statement, we're searching. Are all the revenues earned? Are they in a journal entry already and in the general ledger T accounts, recording them as revenue? If they're not, we're going to have to do an adjusting journal entry to get it recorded. The other principle is called the expense or matching principle. And that tells us when an expense should be recorded. And that says, record an expense in the accounting year it occurs. Occurs. Not when we paid for it, but when did the company receive the service? When did this expense happen? So if it happened this year and we don't have it recorded yet as an expense, this is what's going to create an adjusting journal entry. So we start using these 2 principles really heavy now, and that's what we're searching for, missing stuff. And any of that missing revenue or expense will now have to have a journal entry created for it to get it recorded, because it should be there. So that's what chapter 3 focuses on. What are the typical types of revenues and expenses that are missing and will need an adjusting journal entry? So we could put these journal entries into one of 5 categories. So today we're going to look at each category. We're going to use a problem in our book. I sent you the PDF of the general ledger already and some templates. And we're going to work on that and flesh out this whole chapter for you in the next hour, hour and a half, okay? So let's get started. Are there any questions at this point? Okay, so I'm going to keep going. So now we're going to be explaining the types of adjusting journal entries. And like I said, they could fall into one of 5 categories. So we'll take one category at a time. The first one are prepaid expenses. Okay, so I'm going to give you an example of a prepaid expense, and then what kind of an adjusting journal entry would result from it. So let's say on 9/1 of 18, company paid for insurance coverage that will run from 9/1 of 18 to 9/1 of 19 with cash $2,400. Okay, so this isn't the adjusting journal entry. We saw this kind of journal entry in Chapter 2. This is that normal business transaction. You would have to record this as a journal entry on 9/1/18. And if you remember, insurance is an expense we always prepay. We pay for it before we receive any service. So according to the expense principle, you can't call something an expense until you receive the service, the coverage in this case. So as of today, September 1st, 2018, when the company pays for this, they debit an asset account, prepaid insurance, for $2,400 because $2,400 of a coverage is owed to them, if you remember that from Chapter 2. And then they credit the asset cash because they're paying for it with cash. So now remember, they've paid for this. They just didn't receive any service yet as of September 1st. So this sets us up. So if you make a T account, I can't do it on Word. It'll take me an hour and a half to do it. So you guys know how to make a T account. And if you write on your T account, prepaid insurance at the top, just get a blank piece of paper. I think I'd have one right in front of me, but I don't. Let me one second. There we go. I got a notebook because I got to do this too. Write prepaid insurance at the top, and you should have a debit balance in it if you post this journal entry into it of $2,400, dated 9/1. So you know as of 9/1, you had paid for insurance coverage. So normally our accounting year goes from January 1 to December 31st. We call that a calendar year. Sometimes companies, though, have years that go maybe from July 1st to June 30th of the next year. So you're allowed to do anything you really want there within limits as long as you have 1 year, okay? But if it's not a normal calendar year, it doesn't go from January to December, we call it a fiscal year. So if you come across that term in your reading, that's all that means. In our illustrations here, we're going to assume the company uses a calendar year, okay? So we've been doing our accounting cycle for the accounting year 2018. We are now getting ready to do a financial statement for December 31st, 2018. Well, once we say we're getting ready to do a financial statement, we go, whoa, wait a second. We got to make sure all of our revenues are recorded and all of our expenses are recorded for the year. Now, if you take a look at this, this starts in the accounting year 2018. Even if you draw a timeline, it starts in one accounting year, the coverage for this insurance policy, and it finishes next year. So some of the coverage on this insurance policy is occurring in this accounting year, and some is occurring in next accounting year. So what do? Well, as of December 31st, we ask ourselves, did we receive any insurance coverage from 9/1 to 12/31? And obviously, yes, because the insurance policy covers September, October, November, and December, 4 months of insurance coverage. So what does that mean to us? Well, if we left $2,400 in our asset prepaid insurance and didn't do anything with it at the end of the year, it would look like we received no insurance coverage for 2018, and all of it will be received at a future date. That's not true. We've received 4 months of the 12 months of the policy in 2018. So if we take $2,400 times 4/12, 200, 400, what's that, 800. Or a third of it was received in 2018. So guess what? It should be an expense then in 2018. We say here, and you'll see in your book, your author will say something like, prepaid insurance expired in 2018, $800. So they'll come out and tell you, of the amount you prepaid, here's how much was used up in this year. Okay, so you may not have to do the computation I showed you. I just want to give you the understanding behind what the heck they're figuring out. Another way your author could present this is prepaid insurance unexpired, not expired, December 31st, 2018, $1,600. So it's telling you how much is still remaining at the end of the year, not how much has been used up. So if you want to figure out how much is used up, you have to say, well, how much was it in total? How much is still left? $1,600. $800 was used up or expired. So that's the difficult part of this chapter. In chapter 2, it said stuff like, received cash on account. Okay, here you're going to get a little piece of data like I just presented. Prepaid insurance expired. And then you need to know what to do with it. So what results from all this? Well, the first adjusting journal entry on December 31st, 2018, and I'm just going to call it ADJ1 for adjusting journal entry 1, is we have to debit the insurance expense account for the portion of the insurance we received this year, $800. Don't credit cash because you're not paying it again. You already paid it. Credit the asset, prepaid insurance. So you're moving $800 out of that asset account you stored it in when you paid it by crediting the asset, decrease it, and now calling that portion an expense. It's not owed to you anymore. Okay, so it's a lot of analysis in this chapter. And then beyond that, you have to remember, well, how the heck did we get what's this prepaid insurance? How'd that even get there? So you got to remember, we paid for an expense or insurance before we received anything. As of the end of the year, let's see if we have to record any of that as an expense. And that's the weird part of this chapter. I'm not going to say difficult, but it's weird. It's a different kind of thinking than what you've been doing so far. So that's our first one. Are there any questions? I'm just going to come on over to my chat here. I'm not seeing anything. Or if you wanted to just chime in, that's fine too. Let's see if I can get, oh, look at that. I'm still experimenting here, guys, so just bear with me. I'm trying to make this smaller so it'll stay on my screen. I don't know if it will. Oh, yeah, it is. Okay. So then I can watch for you if there's any questions. So I'm going to do one more, and then we're going to go to a problem in your book and let you try these on your own. And then if you have any questions. The second type of adjusting journal entry is dealing with unearned revenue. Unearned revenue. Now, remember, unearned revenue is a liability account. And that's where we tracked any amounts received from a customer let's see, how could I say this? Before providing the service. So it's really a prepayment from our customer. And we saw that introduced in chapter 2, created this liability account, unearned revenue. Now, that's not the adjusting journal entry, that's what created the account. But we're going to take a look now at an example and show you the adjusting journal entry that results from this unearned revenue. So let's say it's 10/1 of 2018. The company A, that's us, and this is separate from the first one. They're not meant to be together. Receives $1,200 from customer for services to be performed. Let me see. From 10/1, 2018 to 4/1, 2019. Yeah, okay, I had to count on my hands. Okay, so as of 10/1 of 2018, we saw this in Chapter 2. Company A will debit cash. They're going to increase their cash T account. They just received cash. But they don't credit service revenue. They haven't done anything. They're going to provide the services starting in October. So as of today, the day they receive the cash, they have to credit a liability, unearned revenue, to show we owe that service. As of October 1st, we owe that service. So if you made a T account, unearned revenue, and post this $1,200 on the credit side, as of 10/1, $1,200 is sitting in that account. So that's what sets us up. Now, remember, we're focusing on adjusting journal entries. So we are doing a financial statement. So I could put that in here again. We know we're about to do our financial statement for December 31st, 2018. So that's what date we're at now. Okay. And we go, wait, we got to do financial statements. We have to make sure all of our revenues and expenses are recorded. So this deals with revenue. So the question is, as of December 31st, 2018, has Company A provided the service, any of the service, related to this $1,200 receipt of cash? Remember, they owed it as of 10/1. They said they're going to perform it from 10/1 to 4/1. So our question is, has any of it been earned by December 31st? And the answer is yes. The company has earned all of October, all of November, and all of December. 3 months of services have been performed related to the $1,200. Now, the $1,200 payment is for 6 months of service. So if we take 1,200 times 3/6, 1/2 of that is earned by December 31st, 2018. So on December 31st, 2018, we need to do an adjusting journal entry where we will debit our unearned revenue for the $600, debit it, decrease that liability. They don't owe it anymore. Why? They performed the service. So now we can call $600 of that $1,200 payment service revenue. Now we could increase the service revenue. Now, at this point, people are usually sitting there going, well, can we do that every month? Can we just put like, $200? Yeah, you could do that journal entry every month. But if you're not doing a financial statement, you don't have to. And I always kind of look at it from this perspective. What we are doing here is tuning up our information in our accounting system. We're making sure it's perfect so our financial statement is perfect. Kind of like when you tune up your guitar to play a song, if you play the guitar. You don't tune up your guitar and put it back in the case and put it away. It's kind of a waste of time. So you could do these journal entries each month, but if you're not doing a financial statement, kind of a waste of time. Okay, so in the real world, We do these adjusting journal entries every month. But if you're wondering that, sure, you can do it. We're just not going to. We're going to wait till we do a financial statement and see, what do we have to get recorded here? Because it's either revenue that's been earned or expenses that have occurred. All right, guys, any questions? Now, before we go and take a look at the problem, and I failed to do this with our last journal entry, post that journal entry. Now, before, you didn't have a service revenue account. Now you would have to create one so that you have that $600 being recognized as service revenue. You debit the unearned revenue account at December 31st. Oh, and now the balance in unearned revenue on December 31st is $600. Yeah, because company only owes $600 more in service. Okay, so that was a lot to take in. So I'm going to ask you to get your books out and go to page 172. Guthrie Inn is the name of the company. Guthrie Inn. Just bear with me 1 second. Okay. Now, the general ledger I scanned and sent over to you is where Guthrie Inn Company is right now. So they give us an unadjusted trial balance. So let me go back up to what we started talking about very beginning of class. We said this. We're doing the accounting cycle. We're creating journal entries. Well, your author already did that for Guthrie Inn. Your author already posted all the journal entries to the T accounts. And your author came up with balances and created that unadjusted trial balance. So that's what you see in your book. What I did, because I don't have what your author did, was created the T accounts using the unadjusted trial balance. So the unadjusted trial balance figures are where our T accounts are right now. Now, Guthrie is getting ready to do a financial statement. They don't come out and say that, but they tell you it's December 31st and you need to do adjusting journal entries. What I'd like you to do by yourself, obviously, unless somebody's with you that loves accounting and would love to do these too, are journal entries for items A, B, and E. A, B, and E. They give you a little piece of data, and you've got to figure out what kind of adjusting journal entry needs to be created. So I want you to take 5 minutes right now. I'm going to put myself on mute, and I want you to attempt that. If you have any questions during this process, now's the time to ask, and nothing is stupid. So go ahead, try that, and I'm going to go back over to you guys. Okay. Let me see. I'm going to stop sharing my screen, come back over, and like I said, if you have any questions, please post them or take yourself off mute and ask. I'm going to put myself on mute. Okay, guys, I'm back on. Are there any questions before we go over this? I know this is usually where people go, what is this? So if you're feeling that way, relax. Okay, I'm going to share my screen to journal entry. I'm confused. That's okay, Sheila. Usually that's what people do at this point. So let's straighten it out. I wanted you to take a try at it and see if you could tackle it, and is this normal? So I'm going to go ahead over. I already have a journal set up, and you all had that as part of your packet that I put out on the email announcement, whatever I did for today's lecture. And if you don't, you could create a journal in your notebook. But journal entries are journal entries. So the first ones we did in chapter 2, they were to record normal business transactions. What we're going to do now are just to get all the missing revenues and expenses recorded. So all journal entries, no matter why you're doing them, are put into the journal. I put journal entries at the top, but it's the journal. So let's take a look at A. First, let's do the easy part. Put the date of this journal entry into A. Now here's a little piece of data. Like I said, we're not used to this. As of December 31st, Guthrie had $700 of prepaid insurance remaining. Huh? What did we do with that? Well, they give us a clue. They tell us prepaid insurance, right? So I'm going to come on over here and I'm going to put prepaid insurance. And they're saying the amount of prepaid insurance remaining at the end of the year, December 31st, is $700. Well, right now, according to our records, if you look in your general ledger T account prepaid insurance, or even if you look at that unadjusted trial balance on page 172, right now, according to our accounting records, it says the amount of prepaid insurance is $4,600. So if we did nothing to that account, if we did nothing here, it would look like the amount remaining as of December 31st was $4,600. The actual amount remaining is only $700. So we've got to figure out the part that has expired or has been used up. So what you'll do is take the 4,600 minus 700. $3,900 of the 4,600 that was in prepaid insurance has been used up because the only part remaining at the end of the year is $700. So how do we record this? Well, the $3,900 is the amount of insurance service we have received. So we debit insurance expense, $3,900. We reduce prepaid insurance by crediting it for the used up part, $3,900. Now, grab your T accounts, because just like any other journal entry like we did in chapter 2, we must post that T account to the general ledger T accounts. So let's do that. Find your insurance expense T account. On the debit side, $3,900, and you could put your reference there. Then go to the prepaid insurance T account, which is an asset, right? And on the credit side, $3,900. If you find a new balance in prepaid insurance, $4,600 debit, $3,900 credit, $700. So in this problem, your author is telling you how much the balance needs to be after your journal entry. And you've got to figure out the dollar amount for your journal entry. How about some questions? Make that a little, sorry about that. I'm trying to get my chat box up. Won't come up. Come on. There we go. I'm not seeing anything. Let me go back over to you guys. I'm just going to stop sharing a second. Oh, there it is. Are we okay on that? Yeah, Sheila. Yes, because all we're doing is continuing in the accounting cycle. So the stuff that's in there already stays there. We're just updating what was already there to improve it and make the numbers even better by the end of the year. Cool. All right. Let's go to the next one. Kind of the same kind of journal entry. December 31st, at the end of the month, Guthrie had $500 of office supplies remaining. Now, what this means is someone went to the office supply closet and counted the office supplies. And they said, we only have $500 of office supplies still here. Well, what we have to do is go to our T account, office supplies. According to our office supplies T account, there's $800 of office supplies. Oh no, people have been going in that office supply closet and taking stuff. Now, when people go in and take stuff, they don't run into accounting and go, I took a pencil, I took a folder, I took a notebook. Okay, we don't care. Go ahead, take it. What we care about is, are we reporting the correct amount that's still here at the end of the year? So the amount remaining at December 31st is $500. So we've used up the difference, $300 of the office supplies. So on December 31st, we will debit supplies expense for the portion of the supplies that are used up, that aren't here anymore. And then we credit the asset office supplies. If they're used up, we don't own them anymore. They're gone. Decrease the asset. We don't go around inventorying everybody's desk, measuring their pencils. No. Okay, so it's either in the office supply or it's gone. That's the way we look at it. So if it's gone, it's now an expense. So when we buy office supplies, they're an asset. We own them. They're here. But as we use them up, we take them out of that asset category. We decrease the assets, credit $300, and increase the supplies expense. It's very similar to prepaid insurance. They're both considered prepaid expenses. So if you wanted to update your T accounts right now, you could do that. Go to your supplies expense T account. Right now, it has no amounts in it. Well, we're going to put $300 in there. Yep. If we didn't do this journal entry, that wouldn't be there. It would be like there was no supplies used. They were. And then we'll credit the office supplies T account. The office supplies T account now has a debit balance in it of $500. Okay, so this is one approach how your author can describe the data so that you make an adjusting journal entry. Any questions on that? Uh-oh. Whoops. Could you hear me? I don't know what happened there. I'm doing all this work. There we go. I'm sorry. I'm like, I can't find the stuff to stop sharing my screen. Sorry about that. I stopped sharing and then I got a little messed up there. All right, so just as long as you heard me, now you could see the information. You betcha. Sorry about that. The other day I was recording something for my class at LCC. I went through the whole class and I never hit the record button. Curses. So yeah, just yell at me if I'm doing something. Any questions on that though, barring the technology problem there? Oops. Okay, then let's go. I'm going to share my screen. Sorry, I keep just going to stay here. Okay. Let's go then to that journal entry E, because that deals with unearned revenue. So on November 20th, Guthrie contracted to perform services for a client, receiving $3,600 in advance. So that's similar to what we were talking about. I'm just going to flip over to my discussion here. Right here, they debited cash on November 20th, $3,600, and they credited unearned revenue, the liability account, $3,600. So you will see that balance on your journal entry, or I'm sorry, in your general ledger. Unearned revenue has a credit balance in that T account of $3,600. So that's where it came from. Okay. Now, it says as of December 31st, Guthrie has $1,600 still unearned. Okay, so the current balance, according to our accounting record, says $3,600 is unearned. But according to the latest data, as of December 31st, the amount unearned is only $1,600. So the difference of $2,000 is the part that has been earned from November 20th through December 31st. So on December 31st, 2018, we must make a journal entry reflecting that we've earned $2,000 of the $3,600. So just like before, you'll debit the liability unearned revenue, $2,000, and credit service revenue, $2,000. We could post that journal entry to our T accounts right now. So debit $2,000 unearned revenue. Find a new balance in that T account. Oh, it's a credit of $1,600. Yes, it's representing the amount that's still unearned. And then we could go over to our service revenue, increase that on the credit side for the amount that has been earned by the end of the year. Any questions? Just going to come on over. Okay. I just want to make sure I'm sharing still. All right. I'm going to stop sharing my journal, and then I'm going to go back and share my lecture. There we go. All right. So there's 2 of the 5. Let's go to our next one. And it's called depreciation. Depreciation. Now, we hear the term depreciation in the real world, and we think decrease in value. It's going down in value. It's not really what it means in accounting. What depreciation means in this class is, it's the process of expensing the cost of a property, plant, and equipment asset. So we got to tell you what the heck those things are. Over its life due to deterioration. And I spelled that wrong. Give me a clue. Give me a clue. Maybe it'll give me a clue here. No clue. That's not the word. Oh, well, you guys know what I'm talking about. We're not going to fool around. But due to it falling apart, it's going to deteriorate over time. So, you know it has something to do with an expense because it says we're going to expense. What are we expensing? What we paid for a special asset, property, plant, and equipment. Property, plant, and equipment, or PP&E we call it, property, plant, and equipment. Oops. to be. Come on. Is a asset the company uses for more than 1 year in its operations, and it is tangible. You can see it, you can touch it. So we've been exposed to these already. Buildings, equipment, furniture, vehicles. Now, if you're sitting there saying, well, what about land? Well, land is property, plant, and equipment, but land does not deteriorate over time, not like these assets. So we don't expense the cost of land. We only expense the cost of these assets. Now, how do we do that? Well, let's set up an example. Let's say the company on 1/1 of 2018, Company A purchases equipment for $10,000 with cash. Its life is going to be 5 years. Now, the company usually determines how long they will use it. That's its life. Okay. In chapter 9 or 10 of your book, we show you a couple different ways to actually calculate the amount of the expense. In this chapter, we just come right out and tell you the dollar amount of the expense. But for now, let's record the purchase of this equipment. So we debit the equipment, the account, $10,000, right? We increase the equipment, and we decrease the asset cash on the credit side because that's how we're paying for it. Okay, so you can grab your piece of scratch paper and create a T account called equipment and put a $10,000 debit to that account. Now, since we use equipment in our business and we're not using this asset all up within a year, okay, we are going to expense how much we paid for this equipment over the time we use it. That's what depreciation is. So we don't ask anybody what it's worth at the end of the year. That doesn't go into our calculation of depreciation expense. How we normally calculate depreciation expense, we take the $10,000 we paid for it, divided by the life of the asset. And that is the dollar amount we will expense of the equipment each year. You don't need to know that right now, but that's one way we determine it. It's very simple and straightforward. They call it straight line. So in your book, they're going to say depreciation on the equipment for the year, $2,000. They're going to come up with that dollar amount. You need to know what to do with it. And this is where it gets a little more funky, because you might be sitting there going, oh, easy. Well, take a look. So each year, it's December 31st, 2018, we must record as an adjusting journal entry, ADJ, depreciation expense, so an expense amount for any property, plant, and equipment we have. Well, the only item we have is this equipment. We will debit a new expense account, increase a new expense account called depreciation expense for $2,000. Now, usually I'll be in class and I'll say, what account should I credit? And everybody will say equipment. And I'll say, I want to too. I really want to, but we're not allowed to. We use a separate account to keep track of all of this depreciation ever taken on the equipment. And this other account is called accumulated depreciation, and then you put a little dash, equipment. Sorry about that. Now, let's talk about what this account is. Accumulated depreciation is a contra asset account. It's a special kind of an asset. It is an asset, but it's a contra asset. You'll find other contras as we're going through the semester, but this is your first experience with them. A contra account keeps track of information about another account. So since we can't credit equipment directly, it's just the rule for any depreciation for the year, we will credit this contra asset called accumulated depreciation. So here's the other thing. A contra account always increases on the opposite side of its buddy, the account it's keeping information about. So if it's a contra asset, and you think of the word contra, opposite, against, right? A contra asset will increase on the credit side. So accumulated depreciation equipment is just keeping track in a separate account all the depreciation taken on the equipment from year to year to year. Now, when we do the balance sheet, probably Thursday, you'll see how we account for that accumulated depreciation account. What the heck do we do with it? It's an asset. It has a credit balance. I don't get it, right? For now, no, that's where we store any depreciation that is recorded for the year on an asset. That's a property, plant, and equipment. Are there any questions on that? So the key here, guys, is know how to do the journal entry. So I want you to take a 2-second timeout, and I want you to take a look at item C on page 172 for problem 336A and create the journal entry, 2 or 3 minutes. And then we'll come back and we'll complete that together. I'm just going to put myself on mute. I'm going to stop sharing. Okay, guys, let's take a look, and hopefully that wasn't too bad for you. I will come back over. You didn't have to do any of these computations for Part Z. And by the way, this crazy kind of computation will only happen with unearned revenues and prepaid expenses if it has to occur. Okay, so you just have to be careful when you're dealing with those two types of adjusting journal entries. Let's take a look at item C. Excuse me. The only property, plants, and equipment asset this company has is a building. And if you look in your T account, it says building $530,000. Well, that's how much the building costs. And we never change the building account unless we buy another building or sell a building. So it doesn't increase or decrease from expensing it. You see the account next to it, accumulated depreciation building. Oh, that's where we keep track of all the expense that has been taken on the building. So far, this company has expensed $260,000 of the cost. Well, in Part C, it says, well, depreciation on the building that you want to record now is $1,200. So you're simply going to debit the depreciation expense T account, $1,200, and credit that contra asset accumulated depreciation equipment for the amount that's given. Once you complete that journal entry, you could then update your T accounts post that journal entry. Depreciation expense will have a debit. Now it didn't have anything before, and accumulated depreciation will increase another $1,200. So another expense has been recorded. Wow, we're over the hump. 3 down, 2 to go. And the last 2 aren't too bad. So I'm going to stop sharing this screen and come back over. Any questions before I go back to the lecture? Okay, guys. Excellent. Let's go back over here into the lecture. Okay. The fourth type, whoops, I guess I didn't put a 3 on my depreciation. Whoops, there we go. The fourth type of adjusting journal entry is called an accrued expense. And you've actually seen this already. Here's what an accrued expense is. It's an expense that has happened. We've received the service. The expense is done, but it has not been paid or recorded yet. So it isn't anywhere in our accounting records, but we had an expense. So this is a missing expense. If you think back to chapter 2, there was a transaction that said, received utilities bill will pay in 2 weeks. That's an accrued expense. So when you have an expense and you haven't paid for it yet, and you haven't recorded it yet, you make a journal entry. Now, that popped up during our normal journal entries, but that's an example of what we're talking about. I'm going to show you the typical type of adjusting journal entry for an accrued expense that your author tests you a lot on and really is typical out in the real world. So let's say your normal pay week at your company. I wish I could draw it. No, it won't let me. At your company is Monday to Friday. So even if you take and draw a timeline on your little scratch piece of paper, and you want to put 5 lines on your timeline, Monday, Tuesday, Wednesday, Thursday, and then of course the 5th one would be Friday. Okay, so that's the normal work week at your company. Every Friday is payday, $2,000. So every Friday, the company does this journal entry. They debit wage expense or salary expense and credit cash because they pay that week's wages on Friday for all the work done that week. And for the majority of the year, that's the journal entry that happens. Go back to your timeline. Here's the dates I want you to put on. Let's say Monday is December 29th. Tuesday is December 30th. Wednesday is December 31st of 2018. Thursday would be 1/1 of 19 and Friday 1/2 of 19. Now I know that's not how it really happened. I'm just pretending. Okay? There's an issue there. If we wait till Friday when we actually pay and put you don't have to write this down, but just so you can see, 1/2 of 2019, debit wage expense, $2,000. And although we are paying cash on Friday, $2,000, that part would be right, but the wage expense is wrong. If we put all $2,000 on January 2nd, 2019, it looks like all the work was done in the accounting year 2019. It wasn't. 3 days of the work week, Monday, Tuesday, and Wednesday, fall in the accounting year 2018. Only 2 days fall in the year 2019. So that journal entry isn't done. What we have to do is figure out on December 31st, that's what we're focused on. We're not worried about Friday the 2nd. I just wanted to show you that. We're focused on Wednesday. As of December 31st, do we need to record any expense related to the workers? And the answer is yes. They worked 3 days of the 5 days. So if you say $2,000 is for 5 days, so 2,000 divided by 5, that's $400 per day. 3 days happen in 2018, $1,200. So again, since, let me put this in our notes here. Monday, Tuesday, and Wednesday are in 2018's accounting year. Wages related to those days must be reported as an expense in 2018. Okay? If we didn't do that, we would be recording the expense incorrectly. So again, you would take the $2,000 for a 5-day work week, that equals $400 per day, times the 3 days in 2018, $1,200. So on December 31st, we would do our next adjusting journal entry, debiting salary or wage expense, wage expense, $1,200. We're not paying the wages on that day. So we credit wages payable, a liability account, to show we had an expense, it isn't paid for yet, so we owe it as of December 31st. Okay, so it doesn't matter when we pay the employees, it matters when did we receive the service. Just like the utility bill, it doesn't matter when we pay the utility bill, it matters when did we receive the service. We've got to get it recorded as an expense then. So your author will tell you by saying accrued wage expense, $1,200. Or they may give you some information like I did and expect you to calculate that. But when you see that word accrued related to an expense, you've got to record an expense that's missing. Since you're not paying it that day, you have to credit a liability account to show you owe that. Are there any questions on that? Okay, then I'm going to take a timeout and I want you to do the final letter D. Take 2 or 3 minutes, very similar to what we just did, and work on letter D. I'll leave the notes up here. I'm just going to, come on you. Sorry about that. I'm going to pause our recording. Okay, guys, let's see how you made out. I'm going to stop sharing here and go back over to my Excel journal entries. If you have any questions, let me know. I've been trying to keep track of it. Okay. Okay, so in our final journal entry for this problem, but we still have one more journal entry to lecture for adjusting journal entries. 12/31/2018, letter D. Guthrie pays its employees weekly on Friday. Its employees earn $1,800 for a 5-day work week. So if we take 1,800 divided by 5, that gives us $360 per day. December 31st falls on Wednesday this year, very similar to what we saw. Monday, Tuesday, and Wednesdays. So let me do this on here instead of on my notebook. Divided by 5 is 360. Monday, Tuesday, and Wednesday fall in 2018. So 3 days times $360 360 times 3. $1,080 of this week's pay needs to be recorded as an expense in 2018. So we would debit salary expense for $1,080. Since we're not paying it on December 31st, which is Wednesday, we're going to pay it on Friday. As of December 31st, it is a liability that the company owes, $1,080. So we come over to our T accounts and we go to our salary expense. And we will, in the debit column, put 1,080. Make sure you reference that. And then in your salary payable T account, which is a liability, a new liability, 1,080. So if you're ever not sure of what account to use, salary, wages, or whatever, remember you'll always have a list of accounts somewhere. In this case, they were the unadjusted trial balance. Okay, so according to this company, this is the data they found for missing revenues and expenses. We just recorded the expenses and revenues that were missing with these 5 journal entries. Okay, now let's explain this last one, and then it will show you what we do with the rest. So I'm going to stop sharing that, and I'm going to come on back over to my lecture. The final type of adjusting journal entry are accrued revenues. There's that word again, accrued revenues. Accrued revenues are revenues that are earned but are not collected yet or even recorded yet, just like the expenses. So you actually have a revenue that's been earned. You haven't gotten any money from the customer yet, so it's not an unearned revenue. This is, we've done the service, we haven't received any cash from the customer, and we didn't even record it yet. Okay, so the typical type of situation, not all companies have this, but here's a situation. December 31st, 2018. The company finished performing a service for a customer, $1,000. It isn't recorded at December 31st. Okay, very simply. So the company did whatever they usually do, whatever their service is. Customer hasn't paid it for it, and nothing is recorded related to it. Doesn't mean you don't have a revenue. Just means you got to get it recorded. So at December 31st, 2018, or adjusting journal entry 5, we will record it like any other revenue that has not been collected yet. Sorry about that. Debit accounts receivable, $1,000, and credit service revenue, $1,000. Very simply put. So if you come across, and you will in your homework, where revenue's been earned, hasn't been recorded yet, hasn't been collected yet in cash, then you have an accrued revenue. Debit accounts receivable to show that it's owed to you, record the service revenue. You've earned it. You've performed the service. So those are the 5 adjusting journal entries. Those related to prepaid expenses, like prepaid insurance, where you paid, I'm just going to go back up to that part of the lecture. It's been like 3 hours ago, right? There it is. Actually, only about an hour ago. Where you paid for an expense before you received any service. Well, the day you pay it, you call it an asset. But as you receive the service, you move the part of the service you received into expense and out of the asset account. And we did that with our first journal entry there. The second type of adjusting journal entry is those related to unearned revenue. Unearned revenue, remember, is a liability account where we keep track of amounts customer paid before we performed any service. As we perform the service, we take the amounts out of unearned revenue and put them into the service revenue account. The third type of journal entry is depreciation. Remember, depreciation is the expensing of the cost of a property, plant, and equipment over the time we're going to use it due to deterioration. The journal entry is to debit depreciation expense and credit the contra asset, accumulated depreciation. And you'll be given that dollar amount. The next journal entry deals with accrued expenses, expenses that have occurred, that have not been paid yet, or recorded, like the wage expense example. And then the final journal entry was what we just looked at with accrued revenue. A revenue we've earned, we've performed the service, we haven't received any money yet from the customer, and we didn't get it recorded. So now we make these adjusting journal entries to get those missing expenses and revenues recorded. The next step is what we've been doing all along. Post each adjusting journal entry to the general ledger T accounts affected. We've done that for our P336A. The next thing, find an adjusted balance for each T account. So just like after we posted in Chapter 2, we want to make sure what, if any T account balances did change during this process, we update them. Well, cash still has a debit balance of $13,500. Don't have to do anything to that. Accounts receivable, that didn't change during this process, but prepaid insurance did. We credited it for $3,900. So its new balance will be $700 debit. Office supplies, we credited that for $300. So the new balance will be a $500 debit. Buildings still have the same balance, but accumulated depreciation, we credited that account. I'm just going to go back over. Let me just stop sharing that and go back over to the journal entries. So we debited depreciation expense and credited, remember here, the accumulated depreciation, so that increase. So now the new balance in accumulated depreciation will be $261,200. Accounts payable, there was no effect from any of the journal entries, so it stays with the same balance. Salaries payable, didn't have a balance before adjusting journal entries. Now it has a credit balance of $1,080. Unearned revenue had a $3,600 credit balance, but then we debited it in journal entry E for $2,000. So now it has a credit balance of $1,600. Common stock and dividends have the same balance. Service revenue increased. We credited that account in journal entry E2000. Service revenue is $17,500. See, it was missing part of it, added in. Go over to the expenses. Salary expense, before adjusting journal entries, has a balance of $2,800. We added $1,080 with adjusting journal entry D. So it now has a debit balance of $3,880. Insurance expense had no balance before these journal entries, but we posted journal entry A, debit insurance expense $3,900. See, those things were missing. We got them recorded. Depreciation expense, same deal. There was no balance in there. During these journal entries, we debited it for $1,200. Advertising expense was unaffected by adjusting journal entries, so it still has a $620 balance. And then the supplies expense now has a balance of $300 in it. So we're not doing something brand new from Chapter 2. We're just updating and moving on from Chapter 2. Okay, so we collected all of our financial data, normal everyday business transactions. We got them recorded. Now, in this part of the process, we want to make sure all of our revenues and expenses have been recorded. We update our general ledger T accounts for those journal entries. So are there any questions at this point? Nope, I don't see any. Okay. Then the final step, let me stop sharing there, come back over. I just want to make sure you can see the stuff. After we find the adjusted balance for each T account, your final step is create another type of trial balance, but this time it's called an adjusted trial balance. Guys, a trial balance is a trial balance. It's just a listing of all the balances. Well, I should say a listing of all the accounts with their current balances. These are the balances in the T account after we posted adjusting journal entries. So we call these the adjusted balances. So I'm going to head on back to my Excel. Give you a second to copy that down if you're taking some notes. Okay, and we're going to come over to that packet I emailed to you. And there is a trial balance worksheet there. Come on. And you're going to create a trial balance now using your T accounts, the updated balances of your T accounts after posting those adjusting journal entries. So we have Guthrie in company, adjusted trial balance, December 31st, 2018. So you're going to take your updated T accounts, whether they changed or not, and list each one with their balance. So we have the account, the debit, the credit. So cash still has a debit balance of $13,500. Accounts receivable still has a debit balance of $15,100. Prepaid insurance, oh, that balance changed. It's a debit of $700. Office supplies, that changed as well. Debit of $500. And then the building, that didn't change, but we put it down again. Still there, $530,000. And the final asset, accumulated depreciation building, be careful, that is a credit balance, $261,200. So I'll give you a couple seconds, you can get those jotted down. So we list all the assets together. Remember, accumulated depreciation is an asset, a contra asset. Then we keep going. Now we'll list our liabilities. Accounts payable, credit balance of $1,710. So remember, even if it wasn't affected during the adjusting journal entries, it's still there. It's just that it wasn't affected. So you still got to write it down. Salaries payable, $1,080 credit. Unearned revenue, that balance changed also to $1,600 credit. So now we have our liabilities. Next, common stock. $88,950 credit. Didn't change, but still there, we write it down. Dividends, again, didn't change, so the balance is still $23.40 in the debit column. Be careful. Whatever's in your T account goes in your trial balance. Service revenue, that has now increased to a credit balance of $17,500. And then each of our expenses. Salaries expense, whoops. A debit, $38.80. Insurance expense, debit of $3,900. Depreciation expense, equipment, Whoops, or is that building? I'm sorry. Yeah, that's building. I'm getting it confused with my example. 1,200. Advertising expense is still there, just wasn't affected during this part of the process. Doesn't mean it goes away. 620. And then supplies expense, 300. Okay, so we're just writing all those accounts down with their current balances after posting adjusting journal entries. And just like before, you're going to total your debit column and total your credit column. If they equal, you're in great shape. I'll let you finish that up. Are there any questions? I'm just going to wait and give you guys a second or two if you're still working on this, and then we'll wrap up. As far as the requirements of P336A, we're done with that problem. However, and we're not going to do this today, but I encourage you, the next step in our process is make our financial statements. Now, all of the stuff is in those balances. Any missing revenues and expenses have been accounted for. We made journal entries, we posted them to the T accounts, and they are now in our final balances on this adjusted trial balance. So I'm going to stop sharing here, and if you could come back to it later if you still need to jot some stuff down. And I'm going back to our accounting cycle here. So yeah, I'm gonna make this in big letters too because this is important. Now we are ready to make our financial statements. And you have to make financial statements at least once a year, just like you have to do all these steps at least once a year. Remember, we are doing adjusting journal entries whenever we do a financial statement at any time during the year, because we want to make sure all the revenues and expenses are recorded before we make the financial statements. If we don't, we're committing fraud. Okay, so it's really important. So what I'd like you to do is take this adjusted trial balance, go through those financial statements again, except for the balance sheet. That's what I want you to do. So I want you for Thursday, hopefully we'll stay on schedule, complete the income statement for this problem and the statement of retained earnings. And I'm going to be showing you a new and improved way of completing our balance sheet, and that's introduced in Chapter 4. And actually on Thursday, I would like to wrap up Chapter 4 and our accounting cycle, so we're still on track to get a test done next week. At this point, are there any questions? So I'm going to stop sharing my screen and come back over to you guys. Any type of questions at all from anyone? So I know this is a lot to take in, and I'm glad you were here with me live to do this. If you have any questions while you're working on anything, let me know. But Thursday, I would like you to go through the process we just did, but with P335A. That's our homework assignment we're going to review in class. It's on page 171, and it's called Aniston Air Purifications. No, you don't have to complete the balance sheet. We'll do that together on Thursday. Sheila, I could meet you on Thursday at 12:30. Will that work? Awesome. Then we will meet on Thursday at 12:30 in our classroom. But getting back, so you're going to create the T accounts using Aniston Air Purification's unadjusted trial balance, then create the adjusting journal entries like we did for A through G. That's the data. Post the adjusting journal entries to the T account you created, come up with new balances, create the adjusted trial balance. Yes, so P335A you'll do for Thursday. Do all those steps. You don't have to do any financial statements related to P335A. For the one we just did, I would like you to do the income statement and the statement of retained earnings for P336A. You betcha. Any other questions, guys? Okay, well, that's all I have for today. I'm going to make sure this is posted when we're done. I forget, I think it's an MP4, so I think I'll figure out how to get it to you guys. I forget how I do it with Zoom, but we'll get it to you. And if you have any questions between now and Thursday, you can email me. If not, I will see you all on Thursday.